Time now for Stretching Your Dollar, where we give you tangible tips to help you make the most of your money on a daily basis on Closing Bell. While index funds and mutual funds are broadly similar, there are some key differences that investors need to know, especially amid this market volatility. Both funds investing in a variety of stocks, sometimes bonds and other assets. They're differentiated, diversified, but they do differ when it comes to management style, investment objective, and cost. So joining me now to break down what we need to know is financial advisor David Peters. David, thanks so much for joining. And so before we get into the key differences, talk to me more about how these two products, an index fund and a mutual fund, are similar.
Absolutely. So they do share a lot of similarities. I mean, both of them are an investment in a group of investments, like you said. Probably the big thing to remember is that both of them essentially offer some instant diversification within a portfolio because they are an investment in a group of investments. And typically you can do that at a lot cheaper initial investment than you could if you were to buy each of the underlying stocks or assets individually. So in that way, they are very similar products.
Okay, so we've got the similarities. What about the key differences, David, between these two products?
Yeah, so the big difference is that when we talk about an index fund, we have a group of investments that is meant to mimic an index. So an index like the S&P 500, the FTSE 100, something like that, where effectively the investments are going to be made to move in line with that particular index. However, with a mutual fund, mutual funds come in all different types. You might have a mutual fund that specializes in a particular sector. For example, maybe they specialize in the financial services sector. So the underlying investments are made up of financial services-based companies. Mm-hmm. Or you may have a mutual fund that is based off of a particular style. So, for example, maybe a growth mutual fund or something like that. Mm-hmm. But there is a lot of overlap between the two. It's actually possible to have a mutual fund that is like an index, so that actually has an underlying index. So mutual funds come in a lot more variety.
Mm-hmm. Well, active and passive management, I think something that we should talk about here, David. Which funds see active management, which see passive, and what do investors need to know about the difference?
Yeah, so active management is exactly what it sounds like. That's where I have a manager of that fund that is actually making investment decisions for that fund. So with mutual funds, you can have actively managed mutual funds. Now, indexes tend to be passively managed, and so therefore their cost structure tends to be lower. So there tends to be less fees when it comes to index funds. Mutual funds, if they are actively managed, do tend to have more fees, but the hope is that when they are actively managed, that they're going to be able to outperform the benchmark.
Mm-hmm. Of course, very important tips for investors to know as we see a volatile market. David, what should investors realize when it comes to navigating volatility with these products in a day like today?
So that, I think, is difficult. I think that there is a lot of factors that you need to consider. One is obviously cost. Again, when we're talking about index funds, typically we have a lower fee structure than we do with an actively managed mutual fund. But again, when you have a particularly volatile market, the hope would be is that with an actively managed mutual fund that they would be able to better adapt to that market. With an index fund, you're mimicking whatever the return is on the index. So if the S&P is down, well, then that index fund is going to be down. If the S&P is up, then that index fund is going to be up. And so it's the hope would be is that the mutual fund that is actively managed would find a way to manage the volatility maybe a little bit easier. Whether or not that's worth the cost, that's really where I think that we need to make some decisions and probably need to get a sense of where the investor's risk tolerance is and how long they have to invest.
Mm-hmm. All right, financial advisor David Peters joining us for Stretching Your Dollar today. David, thank you.